Hello, welcome back to Dukascopy TV. I'm Ben Jones. You're joining us on Tuesday, so it's time for your first instalment of Commodities Corner for this week. On the line, I have Ian Reid from BMO Capital Markets to discuss with me the current trends surrounding the oil market. Ian, thank you for joining me today. I'd like to talk initially about the price of crude briefly topping $103 a barrel. This is amidst fears that political disruption in both the Ukraine and Libya will damage supply. How do you see these situations continuing to affect the price?
There's always issues with supply globally. Today it's Russia. In the recent past it's been issues with Iran, etc. And of course, we have technical supply issues rather than political supply issues occurring all over the place with either planned or unplanned shutdowns of producing facilities. So it's nothing really new in terms of a long-term historical perspective on oil prices. The fact that we've got some political risk, which is now affecting Russian supply. I'd be surprised, to be honest, if there's a significant amount of disruption to Russian supplies in the longer term. Because the world needs this oil. It'll find its way to market one way or another. What's also interesting, of course, in terms of getting to this level of oil prices is long-term demand, and demand is still relatively strong. We're expecting demand growth of 1 to 1.5% per annum going forward, which is in line with historical levels, and therefore we need a decent amount of supply growth, both in order to make up for decline in existing fields and also meeting this level of demand growth. So we're still relatively optimistic about oil prices going forward.
Elsewhere at Cushing, the US's biggest oil storage facility, there's speculation that stocks are falling. This sent WTI close to a 4-week high. If stocks are falling and continue to fall, how will this affect WTI?
Well, obviously lower inventories and still decent demand equals higher prices. It's interesting that there has been this fall in stock levels in the US at the time when we're seeing more production of oil in the US. So obviously means demand is relatively healthy in the US. So this situation continues, and we're likely to see the WTI price is higher and maybe narrow the discount that's opened up between Brent and WTI.
And finally, what do you see as the significant factors that will affect oil prices over the next 6 months to a year?
Well, I already touched on those earlier. I think supply, there's always a risk that we're going to see some unplanned shutdowns, or maybe the growth that we were expecting in projects is going to be delayed, and therefore there's some pressure from the supply side. On the demand side, with the recovering economies, I think the US and certain parts of Europe are now getting back to more normal levels of demand growth, even though Asia is maybe a little bit less than we were expecting a year or so ago. So I still think demand growth is going to be relatively healthy. So I would be very surprised if we see any sort of precipitous collapse in prices. We're forecasting Brent over $100 this year and $100 from 2015 onwards in the medium term.
Ian, once again, thank you for talking to us today. That's all we've got time for, I'm afraid. Make sure you keep clicking back to Dukascopy TV, though, for plenty more updates and exclusive interviews. Bye for now.